Imagine a world where the price of silver doesn't just climb, it explodes beyond comprehension, shattering records and reshaping global economies overnight. Picture this. By the end of this year, silver surges to $309 an ounce, a level that dwarfs today's market, triggering widespread panic among manufacturers who rely on it for everything from solar panels to military hardware. Factories grind to a halt, electric vehicle production stalls. And the green energy revolution we've bet our future on crumbles under the weight of unaffordable raw materials. Governments scramble to intervene, imposing emergency controls that ripple through supply chains, inflating costs for everyday electronics and even the wiring in your home. But here's the terrifying part. This isn't some distant dystopia. It's the extreme scenario being whispered in the corridors of power right now, fueled by a ticking clock set in motion just days ago by the highest office in the land. And the full truth, the one that could either make fortunes or destroy them, lies buried in a web of geopolitical maneuvers, hidden market forces, and unprecedented warnings from financial giants. Stick with me through this journey, because what unfolds next could determine whether silver becomes your greatest asset or your biggest regret. The stage for this drama was set in the quiet hours of early January, when silver, long overshadowed by its glitzier cousin gold, began to stir with an intensity that caught even seasoned traders off guard. As the new year dawned, whispers of supply disruptions and escalating industrial demand started circulating in trading floors from New York to Shanghai. Silver, that unassuming metal etched into our daily lives through circuit boards, medical devices, and renewable energy tech, was suddenly behaving like a volatile star on the rise. By mid-January, its price had already notched impressive gains. But nothing prepared the market for the explosive surge that hit on January 14th. That day, silver vaulted to an all-time high of $93.22 per ounce. A breathtaking leap that represented not just a daily win, but a culmination of months of pent-up momentum. Investors watched in awe as the metal climbed over 6% in a single session, driven by a frenzy of buying that seemed to feed on itself. Yet, this wasn't mere speculation. It was rooted in real-world pressures from the insatiable hunger of the solar industry, which consumes millions of ounces annually for photovoltaic cells, to the burgeoning needs of AI data centers requiring vast amounts of conductive wiring. As prices pierced the $90 barrier for the first time, a sense of euphoria swept through the commodities world. But beneath the surface, questions simmered. Was this the beginning of a sustained boom, or the prelude to a painful correction? To understand the fuel behind this market movement, we must turn to the analysts at Bank of America, whose January forecast gained attention during the rally. Michael Widmer, the bank's head of metals research, was clear when he outlined a scenario that could see silver prices double, triple, or even more. Drawing from historical patterns in the gold-silver ratio, a metric that compares the two precious metals' values, Widmer described potential price levels that drew widespread interest. If the ratio returned to its 2011 low of 32.1, silver could reach $135 per ounce, a level that would already represent a significant change. But in an extreme case, reflecting the 1980 low of 14.1, the price could rise to $309, a figure that stands far above recent historical ranges. These aren't idle projections. They're grounded in data showing silver's dual role as both an important industrial material and a monetary store of value. Widmer noted that while fundamentals might justify a price around $60 today, increased retail participation could push prices beyond traditional valuation ranges. Retail investors, those everyday participants allocating funds into exchange-traded products, have already directed over $921 million into silver ETFs in the past 30 days alone, with a single day in mid-January seeing $69 million flow into the iShares Silver Trust. This concentrated participation mirrors past market cycles, but with modern influences amplified by online discussion and economic uncertainty. Yet, Widmer also cautioned that elevated price levels often come with volatility, reminding observers that silver has a long history of rapid price adjustments. Adding to this market focus is a policy development that drew attention to critical mineral supply conditions on January 14th. A formal government review highlighted the importance of processed materials, including silver for industrial activity, energy systems, and advanced manufacturing. The assessment emphasized the reliance on global supply chains for these materials. Silver, due to its essential role in electronics and specialized applications, was grouped alongside lithium, cobalt, and rare earth elements within this review. Rather than introducing immediate trade actions, the process established a 180-day period for discussions with international partners to explore pricing frameworks aimed at supply stability. These measures seek to reduce market imbalances and support predictable access to materials. The review noted that if progress is not achieved by mid-July, additional trade options could be considered. Markets responded with a mix of short-term adjustment and longer-term expectation. While the absence of immediate changes led to initial repositioning, the broader policy direction remained a factor for longer-term market participants. In this context, silver's pricing is increasingly influenced by policy considerations and global coordination, factors that may shape future trade dynamics. As global policy signals settled, attention gradually shifted toward Asia, where export regulations on critical minerals were being tightened with precise oversight. Effective from early 2026, revised rules elevated silver to the status of a strategically monitored material, akin to rare earths, with outbound shipments now requiring layered approvals and compliance checks. Only a limited group of companies received clearance to ship silver over the next 2 years, reflecting long-established approaches in major processing hubs that seek to balance domestic and global supply. This was not an isolated adjustment. Comparable restrictions affected tungsten and antimony, metals essential for technology and energy applications. Analysts noted the timing added momentum to silver's rally. With significant shares of global refined silver concentrated in the region, these controls could tighten availability at a moment of surging demand. Solar energy alone is projected to consume record quantities this year, while electric vehicles and AI infrastructure add additional layers of insatiable appetite. The result is a complex market environment where constrained exports intersect with renewed focus on reshoring supply chains, potentially intensifying price sensitivity and market dynamics. Yet, these adjustments also carry inherent uncertainty. If negotiations around supply and coordination face obstacles, ripple effects could impact not only silver, but broader industrial sectors, reminding markets of the delicate balance between availability and demand. Amid this backdrop, silver's price movements in the days following January 14th revealed the market's sensitivity. After reaching an intraday high near 93.22, the metal declined over 4% in a single session, closing around 89.94 by January 16th, as participants reassessed momentum and locked in gains. Volatility spiked, with intraday swings testing traders' discipline, yet the weekly gain still hovered near 10%, underscoring the resilience of the ongoing rally. This pullback did not indicate weakness, but highlighted silver's historically dynamic behavior, capable of sharp retracements followed by rapid recoveries. Institutional buyers stepped in to acquire positions viewed as opportunities, with ETF inflows exceeding $1 billion in recent sessions, signaling growing confidence among large market participants. Beneath the charts, however, a broader narrative persisted. Silver's industrial utility makes it acutely responsive to economic cycles, amplifying movements when growth expectations shift. As monetary policies evolve and central bank signals influence hedging strategies, silver occupies a unique intersection of market speculation and real-world demand, its trajectory shaped by interest rate trends, industrial production data, and global consumption patterns. Delving deeper into the mechanics of price floors, recent policy signals introduce a subtle yet powerful tool capable of influencing market dynamics without overtly altering trade frameworks. A minimum import price functions like an invisible guide, preventing foreign silver from entering domestic markets below a set threshold and effectively lifting the overall pricing curve. If multiple nations align with these floors, supply from non-compliant sources becomes limited, prompting buyers to compete for secure, high-quality stocks. This mechanism can attract investment into domestic mining and refining operations, supporting jobs in key producing states while reducing dependency on external supply vulnerabilities. Yet, the finite window for implementation creates uncertainty. Daily sentiment can shift with progress updates. Smooth alignment among cooperating nations could stabilize markets, whereas delays or miscoordination may spur precautionary buying. Silver producers, from major established firms to smaller exploration ventures, stand to benefit, with stock movements closely tracking spot prices. Execution remains critical, as loopholes or alternative sourcing could dilute effectiveness and prolong market fluctuations. Approaching the midpoint of this evolving scenario, a nuanced contradiction emerges. While optimistic forecasts suggest substantial potential upside, current analysis indicates silver may be considerably overextended at prevailing levels, with fundamentals pointing to more moderate valuations. This tension, between surging retail demand driving prices higher and underlying metrics signaling caution, forms a volatile backdrop. The gold-silver ratio, currently compressed from prior highs, highlights silver's strong performance relative to gold, yet historical trends caution that pronounced deviations often revert sharply. Market dynamics fueled by speculative inflows may face corrections if conditions shift, including changing macroeconomic factors or adjustments in investment sentiment. Even successful stabilization measures can paradoxically limit further upside by ensuring supply balance. This complex reality reframes the narrative, portraying the rally not as inevitable, but as a high-stakes interplay of opportunity and risk, where potential gains and sudden reversals coexist, compelling investors to assess their positions carefully amid mounting evidence of market sensitivity. Pushing through this pivot, the narrative intensifies as we examine the broader macro currents swirling around silver. Resource nationalism, a concept gaining traction in global policy circles, encapsulates nations' efforts to secure strategic assets. From domestic reshoring initiatives to tightened export regulations abroad, silver, with its finite global reserves and concentrated production in Mexico, Peru, and China, emerges as a focal point in this contest. Recent data from geological surveys underscores the stakes. Much of the processed silver for industrial and technological uses is imported, leaving supply chains exposed to potential disruptions. Strategic policy measures are aimed at forging collaborative frameworks with allies to stabilize access, yet delays or hesitations in negotiations can extend uncertainty. Meanwhile, silver's role in sustainable energy shines prominently. Projections indicate solar energy demand alone could triple in the coming decade, intensifying competition for limited supply. Each update in trade discussions or regulatory changes carries the potential to move markets sharply, keeping investors vigilant. The human element in this metallic maelstrom cannot be overlooked. Tales of fortunes gained and lost add emotional depth to market charts. Retail investors, motivated by historical episodes of sharp rallies, participate via trading platforms and online communities, collectively amplifying market volatility. One viral post about accumulating silver ahead of policy-driven price floors can spark widespread engagement, echoing previous meme-driven surges, but with higher stakes. Institutional participants, from large funds to pension managers, hedge through sophisticated strategies, their sizable positions capable of moving prices several percentage points in hours. For miners and local communities, the implications are tangible. Expedited permits and investment can transform remote areas into economic hubs. Yet challenges remain, from environmental considerations to labor capacity and processing facilities, which may constrain the reshoring initiatives. As negotiations progress and deadlines approach, these human and economic stakes converge, making silver's story not only a matter of market mechanics, but also one deeply intertwined with livelihoods and policy decisions across the globe. Escalating toward the climax, the pieces converge in a tense tableau where silver's trajectory hangs in a delicate balance. If negotiations successfully establish robust price floors, the market could reprice, with $100 becoming a new baseline. Miners benefit, and domestic industries gain operational stability. Conversely, delays or failed alignment could amplify uncertainty. Export restrictions tighten, production bottlenecks emerge, and stockpiling behaviors push prices toward extreme forecasts. Historical patterns provide perspective. The 1980 peak, influenced by supply concerns, ended in a dramatic correction that wiped out many speculators. Today's digitally connected market could magnify similar swings. Volatility metrics, already elevated with multi-percent daily movements, reflect heightened market tension. ETF volumes surge, mining shares fluctuate, and analysts adjust targets rapidly. Yet overbought indicators caution restraint. The key insight emerges. Silver's rapid ascent is conditional, dependent on coordinated policy, sustained demand, and disciplined market behavior. Approaching the 180-day implementation window, each headline or policy update carries potential to trigger sharp market reactions, revealing silver's strategic, economic, and societal significance. At this point of heightened tension, the potential consequences crystallize. A scenario of extremely elevated silver prices is not hyperbole. It represents the outcome if supply constraints align with strong speculative demand. Manufacturers face operational pressures. Timelines for renewable energy projects and electric vehicles could be affected, and industries dependent on silver may need to adapt rapidly. Yet opportunities also arise. Early market participants may gain significant advantages. Nations diversify sourcing strategies, and innovation in recycling and alternative materials accelerates. Policy timelines act as catalysts for broader reassessment of supply chain resilience. Market pullbacks, such as modest percentage declines in mid-January, highlight the potential for corrections if sentiment shifts. The unfolding climax is not a single event, but a series of interactions, negotiations, supply adjustments, and demand fluctuations, all converging to shape outcomes. As the dust settles on this extensive narrative, one insight endures. Silver's performance transcends pure investment considerations, serving as a lens on global economic fragility and adaptive capacity. From record price movements to policy-driven market adjustments, and from speculative surges to strategic realignments, the story underscores the complex forces shaping the commodity landscape. Whether prices reach projected peaks or stabilize at lower levels, the lesson remains. Understanding market dynamics, supply dependencies, and policy interventions is essential. This knowledge, once confined to industry insiders, now empowers all who seek to navigate the evolving global economy. As developments continue to unfold, participants are reminded of the importance of informed engagement and awareness in a world of interconnected markets.